Back to our uh, weekly real estate conversations on Friday, and today there are two topics that we'll go over. One is I want to give you a quick recap of the current state of affairs of our Spokane housing market, so you have an idea as to where uh, things stand, and also you can be better prepared to um, to navigate this upcoming busy spring selling season. I also have a loan officer, Jessica, which will be joining us here very soon. And she will be sharing with us a really cool first time home buyer loan program that allows you to buy at a fairly high price point with virtually no money out of pocket. Certainly, there are some guidelines that you will have to meet to qualify for this loan. That said, the upside is really good. So with that said, let me just I see you, Jessica, on deck. I'm gonna go ahead and share my screen to go over some stats about the Spokane housing market, and then we'll bring Jessica on to talk to us about this amazing loan program. So let me there we go. Let me share my screen. So a few things that I want to share with you. Essentially, three stats. Number one is median sales price. The median sales price at the end of March was essentially 410, and that is an increase of 5% from the previous month, February, when it was $390,000. So it's up almost 20 grand month over month. The next stat is days on market, essentially telling us how fast our property is selling uh, in our market. And you can see that it actually went down from almost 10 days 2 months ago to just a week at the end of March. The next stat is months supply of inventory. And this is really important because essentially this is the main stat that tells us where prices are heading. And you can see that we went from a 2 month supply at the end of February to a month and a half supply at the end of March. Essentially, what that tells you is that the inventory or the supply of houses for sale is getting tighter. And that is the main reason why we should not expect home prices to collapse anytime soon here in Spokane. Even though interest rates have been on the uptrend compared to what we had in the last 2 years, because we don't have enough houses for sale to meet demand, it is unlikely that we will see home prices here in town collapse. Now, when it comes to the actual number of houses for sale, it went up. Back in February, we had 600 houses for sale. Then last month, we had 700 houses for sale. But the thing is that the rate of which these houses are going under contract went up, which is why now the supply went from 2 months to 1.5 months, even though more houses came up for sale. And here's the stat that tells you that story. At the end of February, we have 477 houses going under contract. And then last month, 550 houses went under contract. And now this is, let me just go back here. This is a reflection of the seasonality of our market. We see this happening every single year. The uptrend that you saw on the median sales price from 390 2 months ago to now 410 last month, chances are will be even higher at the end of this month and continue the uptrend until it will peak around July, August, just like it does every single year. So, in practical terms, what this means for you as a buyer is you have to be ready to compete in the upcoming and essentially here spring selling season, just because houses are selling faster and there's more competition going on the market, meaning more buyers re-entering the market. Now, all this said, know that this is a snapshot of our Spokane housing market as a whole. So if the data I'm sharing with you doesn't match what you're seeing in your specific area or neighborhood, please remember that real estate is always hyper local. What I mean by that is that there is a different dynamic between supply and demand in different parts of town. For example, houses up in the South Hill or prices on those houses don't behave the same way as home prices in the Shadle area or North Central or Mead or Spokane Valley, Liberty Lake. So all these areas have their own specific dynamic. That said, it is important for you as a buyer and seller to have a point of reference, which is what this snapshot of the overall market gives you. So hopefully that's helpful. And now let's go ahead and bring our guest today. Jessica, good morning.
Good morning. How are you?
I'm doing well. How are you doing this morning?
I'm wonderful. Thank you. Thank you
Awesome.
for having me.
Of course, of course. Well, Jessica and I actually met just a couple of virtually, I guess, over the phone a couple of weeks ago. One of her clients wrote an offer on one of my listings, and once I got on the phone to talk to Jessica about her client's qualifications as a borrower, I learned about this loan that I hadn't heard before, and it piqued my interest. So essentially, it's a first-time home buyer loan gives you the ability to buy at a fairly high price point with relatively uh, close to none zero money down. So with all that said, I'm going to let Jessica take it over and just share with us some of the guidelines to qualify for the loan, some of the upside, and also some of the risk of this option. So go ahead, Jessica.
Thanks. So, with Idaho Central Credit Union, we have a product that I feel as though it's truly amazing. It's for first-time home buyers, and it will allow a first-time home buyer to put as little as only $1,000 is actually their only requirement down, and for a maximum loan amount up to 600,000. So, especially in the Spokane area, that 600,000 is definitely, I mean, you probably know more than I do in regards to what the average purchase price, but what I'm seeing recently is, around the 450 to five. So it is nice that we will actually go up to 600,000. We don't want to exceed, though, a 43% debt to income ratio, which, to be honest with you, I always like to stay in that range of not exceeding a 43% debt to income ratio for my clients. And one of the biggest benefits, too, with
Before we move forward, sorry to interrupt, just so we don't lose anyone, let's just define our terms. And can you briefly explain what the DTI or debt to income means?
So, debt to income ratio, basically, what that means is we take any debt that's reporting to the credit bureaus, and then adding on the debt, the new debt of the mortgage, and then combining that with someone's income. And with that, though, we're going off of income that is before taxes. So that's why we're obviously not wanting to use all of someone's income, because truly, at the end of the day, what their take home is far less than what, let's say, their salary is, right?
Mhm.
So the 43% debt to income ratio is a nice threshold, so that they're obviously not house poor, right? So that
Mhm.
they have money left over after paying their mortgage and all of their other bills.
Right. And just to clarify, the 43% DTI is a requirement specific to this loan program.
Correct.
For those of you who have a higher DTI, there are plenty of other loan options that will allow you to go
Correct.
higher than that. Some of them, I've seen it go above 50%.
Yes.
So just to make the point that this 43% guideline is just specific to this loan program.
Correct. We have two first-time homebuyer products with the zero down, and so one is it's a 30-year term. It's a it's the 100% financing, no MI, up to 600,000. And then we just recently released a same guidelines in regards to zero down, no MI, up to 600,000 loan amount, but a 40-year term. That one allows for a debt to income ratio up to 45%. So you're absolutely correct. It's always product driven in regards to where the DTI needs to be, and that's why I always say every borrower, every person has obviously different income, different assets, different debts, and so I always like to sit and meet with someone to see the big picture and show the different products that would be a benefit to them and keep them in a payment that's comfortable.
Right. Did you say that this product does not have MI?
Correct.
Yeah.
That's correct.
That
So that in itself is a huge savings.
Yes.
And I know that when we spoke, which is why I always make a point to reach out and make an introduction, is because when I have borrowers that are putting very little down and with the market getting more competitive, sometimes that offer can look unattractive compared to someone that, let's say, is putting 20% down or 50% down. But it's not always the fact of they don't have the assets. It's just taking the benefit of being able to put very little down with having the same benefit of avoiding MI.
That's incredible. So just let's recap the benefits so far. So up to $600,000.
Correct.
With the down payment required of $1,000. 43% debt to income ratio. And no mortgage insurance.
Correct.
Okay. Any other benefits?
I mean, that
alone is good enough. Yeah.
So the other benefit is because of the fact that with Idaho Central Credit Union, we are obviously, it's the mortgage is staying here. We're servicing the loan. We're keeping it in house. It's a 5/5 arm. And so what it means also is after closing, the borrower can actually reach out to me, or I typically will reach out every 12 months to see if they're interested in a rate reduction for a flat fee of $500. So instead of having to go through a full-blown refinance, right, which costs thousands of dollars, they have the ability to do a rate reduction every 12 months for the flat rate of $500. Which is fantastic because of the fact that, as we all know, rates today are higher than they were a year ago. And so if rates, no one has that magic ball on where rates will be in the future, but the benefit is if rates do improve in the future, that our borrowers can capitalize on that without having to refinance every time they want to improve their interest rate.
Now that you bring that up, rates. Is it a premium for this product in terms of interest rate, or is it competitive with the in line with the market?
It is in line with the market. We're very we try to be as competitive as possible in the market, and but at the same time, obviously, with rates, they're driven by a numerous amount of factors. So that always comes down to meeting with my clients and seeing exactly where their credit is. Everything plays a factor into what that interest rate is built on.
But it is a fixed rate product, right? Either 30...
So there's two different options. So the 30-year term is actually a ARM product. It's a 5-year ARM product. The 40-year is a fixed rate. So it's nice now that we just recently, a few weeks ago, released the 40-year fix because of the fact that just for some who aren't comfortable with any ARM product at all, this does allow for the fixed rate term.
Can we unpack that? Let's go over the ARM option and just explain it for us.
So what it means is so the ARM products, it's a 30-year term. And ARMs, basically, there's always a 3, 5, 7, or 10-year ARM option. And so,
ARM means adjustable rate mortgage.
Correct. Right. But you, in that 3, 5, 7, or 10 years, that initial term, that's when you're locked in at typically a lower interest rate. than what you would see on, let's say, a 30-year fix. And so, especially right now in today's market where the rates are so much higher, the ARMs tend to be more attractive because of the fact that you can capitalize at a lower rate. There's no prepayment penalty. We don't have any products that have prepayment penalties, but many moons ago, ARM rates had prepayment penalties, so they weren't very attractive. And part of the reason why they released a 7 and a 10-year ARM in addition to the 3 and the 5 is to give people, more time in that lower fixed rate. And when you think about it, if you look on the average, the days of people getting into a 30-year mortgage and actually staying in that one mortgage for 30 years and never touching it are very, very slim. The average person probably refinances every 4 or 5 years. And that's to either capitalize on a rate reduction, or that's to pull cash out, reduce their term, whatever it may be. There can tend to be advantages to a homeowner to refinance, let's say, in a 4-year period of time. I always like to make sure that it is to their advantage when they do a refinance, to make sure they're not just incurring closing costs for a pretty rate.
Right. What do you see? I mean, one of the main advantages of our ARM option is, of course, the savings that come with a lower rate. What do you see as some of the disadvantages of that option?
Well, there's obviously your of course it's a risk, right? So it's a risk of, if let's say you stay in it long enough to adjust, that it adjusts in a higher rate that isn't attractive, right? So you always have, let's say, for example, a 5-year ARM. And so come year 6, if the rate adjusts and it goes from, let's say, for example, you go from 5% and then it goes to 8%. Let's just throw out a figure, if that's where the market is, right? And that would obviously be a payment shock, right? Because your payment would then go up. So it's a risk that you're taking on. There is potential that after the loan is locked in for that 5 years, it can begin to adjust. And if you don't have the ability to refinance, let's say, then you're stuck with that higher payment. But majority of the time, that's why most people are refinancing long before the rate even has that opportunity to adjust, because of the fact, like I said, there's no prepayment penalty to refinance during that time when you're locked in at the lower rate, which is nice. So, and that's why I was saying, with our first-time homebuyer product, with the 5-year ARM, during that 5-year period, someone can actually every 12 months do our rate reduction if the rates improve for the flat $500, which is nice.
So when the 5-year are the initial 5 years are up, those rate reductions that would have taken place within that time frame, do they stay with the loan, or will that change?
Well, so obviously at come year 6, that's when it begins to adjust, right? So the rate obviously will adjust just based off of the market. But of course, if they have capitalized on rate reductions, then that plays a factor as well, which is good.
So it does mitigate for that increase on rate after the initial
Correct.
ARM period.
Yep.
Okay.
But that's why I say the nice part is for those who, excuse me, are completely uncomfortable with any type of ARM product, no matter what. It's nice now that we have the 40-year fix option to show.
Which will be at a higher rate.
Correct.
From the
because
get-go.
it's a fixed rate. And it's a
Awesome.
40-year term. So it also helps those who need to improve their purchase price, and it gives them a little bit more room to work with, so that it's not stretching their monthly payment out too thin. The 40-year term obviously can allow for giving a little bit more of a opportunity for a little bit of a, let's say, for going from a $450 purchase price to a $5. that can help them and still stay comfortable in a monthly payment.
Yeah, and the ceiling does not change. I mean, there is a hard ceiling at 600.
Correct. Yep,
Okay.
on both products.
Okay. What are some of the disadvantages as a whole of this loan product? So everything sounds amazing, but I'm like, is there a catch here?
No, there isn't a catch. Yeah, it's funny. I mean, I think you had asked me that when we spoke on the phone too. There's really no disadvantage. The other qualification also is actually a 720 credit score or higher. But there is truly, I mean, when you're able to get into a home, and this is the whole reason why Idaho Central has created these products, is to be able to help first-time home buyers be able to get into homes without feeling like they have to save thousands and thousands of dollars in order to get into the market. So it's an amazing benefit by being able to get into a home, be on in a conventional mortgage, not have hundreds of dollars spent a month on monthly mortgage insurance. It's just fantastic. I can't think of a negative, really.
Mm-hmm. Yeah. I mean, the only thing that comes to mind is, of course, the high. I mean, there is always a trade-off. And, I always say that there is not a perfect loan product out there. So you just have to be aware of the trade-off and be comfortable with it. So in this case, the only thing that I can think of is that you are trading off a really low out-of-pocket expense to get into a house for a higher monthly payment. Because, if you're getting a loan for $500,000, $550,000, $600,000, and only putting down $1,000, then what that means is that your loan balance is going to be a lot higher than someone who would have put down 10, 15, 20%.
Correct.
And in this case, there will be that trade-off. But outside of that, I cannot think of anything else that will be a downside. So who would you say is an ideal borrower for this type of product?
So it would be ideal, obviously, is first-time home buyers. And like I said, 720 is the minimum FICO required. And it's not just Washington, but obviously, Washington, Idaho, Oregon, Arizona. But primarily, for us, it's really just helping first-time home buyers get into a home. Whether they have 5 or 10% saved down or less, it's truly an amazing product. That's not a grant. There's no catch. So it's being able to get in front of more people because they truly don't know that this product exists. So that's what I'm working on is getting out and educating everyone out there, buyers that are needing to know what their opportunities are.
Yeah, no, I didn't know about it until I saw the offer that your client sent in. And I'm like, what is this? And then I called you, and anyways, this is a really amazing program, sounds like. And for those who are interested in learning more about it and whether or not they can qualify, how can they get in touch with you?
So best thing is to reach out to me on either my website or honestly, call me, send me an email. I would love to set up time and meet face to face and talk about what all we have to offer.
What is the best number to reach you at?
425-761-8099. And then my email is jshew, which is SHEW, at iccu.com.
Perfect. And I'll go ahead and also put that on the notes on the post.
Perfect.
All right, Jessica, well, is there anything else you feel we need to know about this loan option before we wrap it up?
No, I think we've got everything covered. So I'm excited to share more.
All right. Well, yeah, thank you for carving out the time and coming on and sharing with us. And for all of you watching today, I hope you got something out of this. And now you feel a more informed and better prepared buyer to navigate this market. Thank you all and have a great weekend. We'll see you next week.
Thanks.